let's get right into it. We've all been there, right? You see this picture-perfect breakout starting to happen. You jump in, feeling that rush, and then, bam, the price reverses and you're trapped. It's one of the most frustrating things in trading. So today we're going to tackle this head-on. We're going to figure out how to tell a real breakout from a fake out so you can finally stop getting caught in those nasty traps. So, have a look at this chart. What do you see? It's a textbook setup, isn't it? A big, powerful candle just smashing through resistance. Your first instinct is probably screaming, buy, buy, buy. And honestly, why wouldn't it be? It looks perfect. But here's the kicker. This is exactly what a trap looks like. It's designed to look good, to pull you in right before it pulls the rug out from under you. So the big question is, how do we know this is a fake out?
And look, this isn't just you getting unlucky. This is a huge, huge problem. Get this, a staggering 70% of breakouts fail. Let that sink in for a second. 70%. That means for every 10 breakout trades you take, 7 of them are statistically likely to go against you. That's not a fair fight, is it? This is exactly why so many traders struggle. We're playing a game that feels rigged from the start.
All right, Section 1, the problem. Let's really dig into the anatomy of a trap. See, before we can avoid the trap, we've got to understand how it's built. We'll start with what a breakout is supposed to be, the textbook version, and then we'll look at the ugly reality that trips up so many of us. So what is a breakout? I mean, the way we all learned it, right? It's when the price smashes through a key level, support or resistance. And crucially, it does so with a big spike in volume. That volume is supposed to be the proof, the confirmation that a new trend is kicking off. On paper, it's so clean, so logical, it makes perfect sense.
But a fake out is a whole different beast. It's a masterclass in psychological warfare. You see that candle break out and your brain just lights up with FOMO, that fear of missing out. You think, this is the move, I have to get in now. So you do. And for a glorious second, you feel like a genius. Until the price slams back down, leaving you trapped, confused, and probably a little bit angry.
Okay, so here's where things get really interesting. You need to understand that these fakeouts, they're not just random market noise. They're not accidents. Oh no. More often than not, they are deliberately created. They are engineered. To see how, we have to pull back the curtain and look at the playbook used by the big money, the institutions, the operators.
Why do they do it? It all boils down to one single reason. And you need to remember this. It's for a liquidity grab. That's it. This is the entire purpose. It's not noise. It's a calculated move to take advantage of the predictable behavior of retail traders like us.
So what in the world is a liquidity grab? Think of it like this. A big hedge fund wants to sell, say, 1 million shares. They can't just dump them on the market. The price would crash. They need 1 million shares worth of buyers. So where do they find them? Well, they know exactly where all the retail breakout traders have their buy orders waiting right above that key resistance level. It's a giant pool of buy orders just sitting there. So they push the price up just enough to trigger that entire pool. All our orders get filled, providing them the liquidity they need to execute their massive sell order. It's genius in a very predatory kind of way.
And the maneuver itself is brutally simple. It's a 3-step dance. Step 1. They push the price just past that obvious, juicy level that everyone is watching. Step 2. That push triggers a chain reaction. All our breakout buy orders fire off and all the shorts get stopped out. Boom, liquidity captured. Step 3. Now that they've filled their own orders, they let the price collapse or even help push it back down, trapping every single person who just bought the breakout.
I really want this to sink in. You have to burn this quote into your brain. Operators know where your stop loss is. It is not a coincidence. It's not bad luck when the price ticks your stop to the exact penny and then reverses into a massive winner without you. They know the obvious spots we all put our stops, and they hunt them. It's a feature of the market, not a bug.
All right, Section 3. We've talked a lot about the problem. It sounds a bit grim, I know. But here's the good news, and it's really good news. These traps, they leave footprints. They have tells. You can absolutely learn to read the price action and tell the difference between a clean, powerful move and a dirty, fake signal. So let's flip this around and talk about the solution.
Okay, let's put these two side by side, because the difference is night and day once you know what to look for. Over on the left, we have a clean breakout. Look at that beautiful, full-bodied candle. It closed with authority, way above the level, and check out the volume bar below it. It's a monster. That's conviction. Now, look at the one on the right. See that pathetic little candle body and that giant upper wick? That long shadow is pure rejection. It's screaming, sellers are in control here. And the volume? It's weak. There's no power, no belief in that move. It's a trap waiting to spring.
So let's get specific. What are the hallmarks of a fake breakout? What are the red flags you need to be watching for? First, that long upper wick we just saw. That's a huge sign of rejection. Second, low or even worse, declining volume. This is a big one. It means the big players are not interested. Third, there's no follow-through. The next candle just kind of sits there or even reverses immediately. And fourth, often the price is already way overextended, really far from its key moving averages, like it's running on fumes.
Now let's flip it. What are the signs of a clean breakout? These are your green lights. First, you often see a buildup or a tight consolidation right below the key level. It's like the market is coiling a spring, getting ready to pop. Then, you get that massive, sudden spike in volume. It's unmistakable. Third, the candle closes a full, powerful body, very little wick on top. And finally, and this is so important, when the price comes back down to retest that old resistance level, it holds. It becomes new support. That's confirmation.
Okay, your defense, the 5-step filter. Knowing the difference is great, but we need a system, right? Something practical and repeatable you can use every single time you're about to click that buy button. So here it is, a simple 5-step checklist to filter out the junk.
Let's break it down step by step. Number 1, check the structure. Is this level actually significant? Is it clean with multiple touches? Number 2, confirm the volume. Is there a clear, undeniable spike in volume on the breakout candle? Yes or no? Number 3, wait for the candle close. This is so important. Don't jump in mid-candle. Wait for it to close. Is it a strong, full-bodied candle? Number 4, look for a retest. Are you seeing price come back, touch the level, and hold? And finally, number 5, check the context. Are you trying to buy a breakout in a roaring downtrend? You want to trade with the current, not against it.
Here it is. This is probably the most important takeaway from our entire chat today. The golden rule. If 3 out of those 5 checkpoints are missing, you skip the trade. End of story. Don't argue with it. Don't hope. Don't think this time is different. Just skip it. Because the odds are overwhelmingly high that it's a trap.
So now we have a tactical plan, but tools are only as good as the person using them. So let's talk about the final piece of the puzzle, the trader's mindset. This is about setting a realistic goal.
Look, I'm going to be straight with you. You will never, ever eliminate fakeouts completely. They're a part of the market ecosystem. Sometimes, a setup will check all 5 boxes and still fail. That's just trading. The goal here isn't to be perfect. The goal is to avoid the obvious traps. The goal is to stack the odds in our favor one trade at a time.
This is what that looks like. Without a process, without a filter, trading breakouts is pretty much a 50-50 guess. It's a coin flip. But once you start applying a filter like the one we just discussed, you can dramatically shift those odds. Maybe you go from a 50% guess to a 70 or 75% edge. You're no longer just gambling. You are now operating with a real statistical advantage.
And that right there, that small improvement, that edge, that is everything. That is what builds a trading account. That is what builds a successful trading career. It's not about one huge win. It's about having a small edge and applying it with discipline over and over and over again.
I'll leave you with this one final question to really think about. If you start using this filter, you are absolutely going to trade less. You'll be sitting on your hands more, waiting for those A-plus setups. But the real question is, will you trade less but win more? That's the trade-off, and I think we both know the answer.